Hello, everyone, and I welcome you to this edition of InSync, our periodic outreach sessions to discuss financial reporting landscape and recent updates. This quarter had been quite eventful, as you can see on the slide. We will take you through some of the key developments that has happened in this particular quarter. We will talk about the effect of tariffs and tokens, which are basically US B1B visas, the effect of that on financial reporting. We will talk about the developments on accounting standards. SEBI had been quite active on related party transactions. We would take a quick look about those developments. And lastly, we'll close this session with some of the critical developments that has happened by the NFRA. As far as tariffs are concerned, uh, we have been exposed as a country some of the highest tariffs uh, uh, from for the exports that is being made from India to the United States. As we know, US as a market is one of India's largest export market, and any disruption in that particular market would obviously have a ripple effect across multiple entities in the Indian economy. Uh, as I said, it's the highest tariffs that has been levied for products being supplied to the United States. Sectors which we believe are at risk are sectors which are either labor intensive or which are capex heavy sectors. For example, the sectors like garments, natural produce like rice, gems and jewelry, and auto and engineering goods. These sectors might be exposed to significant amount of risks and challenges. In addition to the US tariffs, we also saw the US government levying one-time visa renewal fee on account of H-1B visas to professionals, which would be going to the US for the purpose of their activities. So these are expected to be levied effective 2026, and there had been certain clarifications which the government has given. But again, that is important consideration, especially for the IT sector to look at and consider in their overall business strategies. Uh, in addition to that, as far as the tariffs are concerned, the US Supreme Court is expected to hear uh, the the legality of imposition of tariffs in November 2025, right? As far as H-1B visas are concerned, the Hire Act has also been proposed, which is expected to levy 25% payments or a 25% levy on payments being made to overseas worker. So again, the US as a market and US as a jurisdiction are posing significant challenges from economic and business disruptions, and this will obviously have a trickle down effect on the financial reporting per se. As far as the mitigating measures are concerned, the intent and the effort has of the government is to spur domestic consumption. So we would have seen a flurry of new trade agreements that as a country we had signed with the UK, with the few European countries, with Switzerland, and there are also free trade agreements being in discussion with Canada. In At home, I think they have the government has slashed or rationalized the GST rate, and we are trying to see some effect of that in the domestic consumption. The government has also proposed targeted incentive schemes, for example, the production linked incentive schemes, and its reach is being widened again to boost domestic consumption. So what we believe is that these are not just sectoral specific nuances or sectoral specific risks. We live in a globally connected economy, and it is obvious that if there is a challenge with one of our largest export market, many of the entities and sectors which may not be directly affected but still could get some kind of a hit. So it is not possible to rule out that the adverse effect is limited or isolated to a particular sector. Uh, these effects can have a very wide-ranging effect on supporting or ancillary business. And what we have also seen from a tariffs standpoint, for example, pharma was not tariffed, but now any branded drug that is being sold to the US market is also being subjected to tariff. So again, we cannot rule out whether in future other products or maybe other jurisdictions which will be tariffed by the US government. So again, all these factors are only accentuating or heightening the existing financial reporting challenges which the corporates are facing. We also thought to bring out certain perspective from the press, and if you could see on the slide, the concerns raised by one of the credit rating agencies of our country, or the report that has gone to the finance ministry on US tariffs, they also kind of reiterate these financial reporting challenges. Governments, as I said, is under pressure, that particular sector being reliant on the US market or being reliant on labor domestically, that is expected to have quite a few ripple effect. Now, these are the top five financial reporting challenges. What are the risks that we thought we want to highlight and leave it with you? But before we get into that, what we want to highlight very, very clearly is that we need to have a holistic uh, outlook on these challenges. Only because this sector is not directly affected, that doesn't mean there is no risk. There can still be a particular risk which these entity might be facing. So the thought that we want to leave with you is that just because it is not yours, that doesn't mean there is no risk. The risk exists, and as a preparer of financial statements, we need to consider these risks and factor them for our financial reporting purpose. So let's see what are those top five risks are. Now, there could be concerns about long-term competitiveness risk. So, for example, if there are other competitors in the market, other jurisdictions which are subjected to a lesser tariffs, then obviously we lose the competitive edge. So again, there could be a very wide scale disruption or or lack of acceptance of the products that is being sold from India. We also spoke of global connectiveness. So there could also be challenges on supply chain because we work on a global platform, and any challenges on our supply chain or our vendor or MSMEs, right? It will have a direct effect on the entity's financial prospects. There in certain scenarios, which are the entities that is being listed and directly hit by these disruptions, we could see a steep loss of market capitalization. Servitization could also be happening. Servitization means that uh, the entity might be shifting its business model. They might like to add services or increase the quantum of services in its packaged in its products. So at present, the entity might be a goods focused entity, but considering that services are not looked at with that degree of concern, the products that I sell might be bundled with services, so to negate the effect of tariffs. So again, a possible change of business model or a product mix which we might anticipate in the future. We also spoke of GST. Uh, there, there could be scenarios where the duty structure of GST is inverted, which means that my output's GST rate is lesser as compared to the input GST rate. So again, this creates challenges about recoverability, especially about the timing of GST input credit. Now, if I have to sum this up, there are possible implications on financial reporting, especially on impairment of non-financial or non-current assets, determination of NRV or net realizable value of unsold stock could be an area of concern. Onerous contracts, if we have long-term contracts and there is a curtailment of our production or our revenue, these long-term contracts might trigger assessment for onerous provisions. Significant estimates and judgments. The accounting standards require the entities to disclose significant estimates and judgments. Because of these heightened uncertainties and risks, we might need to elaborate or introduce new disclosures in the financial statements. Moving on to the accounting developments, we had two significant developments from accounting standpoint, starting with amendments to Ind AS 1. Effective April 25, the definition of current liability has been amended, and they have been made effective from 1st April 25. So to start with, we have a condition which says that if there is an unconditional right to defer the liability, then it is a current liability. Now, a subtle change has been made to that. Uh, it is now amended to say that if there is a right to defer instead of an unconditional right, now that would be a criteria for classifying a liability as a current liability. What about settlement of liability with owners on equity? That has also been clarified and introduced in the standard to say that the settlement of a liability by using an entity's own equity instrument is treated as settlement, except when the conversion option of a compound financial instrument is classified as an equity instrument. So again, important consideration which you might need to look at. Now, as far as the right to defer settlement, especially about the breach of covenants, what I would like to draw your attention is the point in time when these condition has to be looked at. This should be looked at as at the reporting date. Now, what the standard very clearly states that the existence of right to defer settlement, or let's say there has been a breach of covenant, whether the covenant breach has to be looked at as of the reporting date, or whether we need to consider breaches which are expected to happen after the balance sheet date. So in a nutshell, the Ind AS has very clearly clarified and stated that the right to defer settlement should exist as of the balance sheet date, which means that the breaches or the compliance with covenants has to be looked at as of the balance sheet date. So if there is a breach or a compliance with a covenant condition has to be looked at after the balance sheet date, that will not affect the current classification of a particular liability. We have also seen that because of this amendments, there are disclosures that has been introduced. For example, difficulty in complying with covenants. That would be a key consideration for other stakeholders. Effective April 26, there is expected to be a significant development. We at present under Ind AS 1 have a carve out from the corresponding international standard. That carve out is expected to go away from 1st April 26. Quickly to jog your memory, uh, we have a existing carve out which says that if a waiver of a material breach is granted before the approval of financial statements, the liability would still be considered as current. Now that was more of an Indian kind of a consideration. I think the ministry is now looking for a very closer convergence with the corresponding international standards. So effective April 26, we would see this carve out to be removed. A few considerations which you might need to look at: if there is a period of grace or a waiver, are in absence of a particular definition under Ind AS, how you would need to consider. One view could be that the period of grace is an extension of an existing period and hence there is no breach per se. So again, a very nuanced and a closer consideration might be relevant. Now, the interaction with the covenant breach with the going concern assessment, what we would like to clarify is that both are two separate assessment. Only because the point in time of of the covenant breach has to be looked at as of the balance sheet date, that doesn't change the assessment of going concern. Going concern, as we know, we need to look at a minimum period of 12 months from the date of approval of financial statements. So that I don't think is linked with the Ind AS amendment on consideration of current and non-current classification. Disclosure requirements, a covenant breach, yes. I think we spoke of new disclosure requirements that might require a particular interest and hence would require a disclosure in the financial statements. If there is a material breach of a covenant and it has been condoned uh, before the financial statements approval, or does it mean that it will require a particular disclosure or a particular consideration? We believe that it might be, especially in the context of significant estimates and judgment. That might be an important area for the preparer to look at. Next important amendment is the supplier finance arrangement. We have seen this kind of arrangement in certain industries or sectors, for example, auto components, that is quite prevalent. In this particular arrangement, the entity which purchases goods from another entity will have a fixed kind of a credit period. Now, through this arrangement, a banker is involved and the vendor is paid at uh, paid at a particular time, which might be, you know, upfront in certain cases. So again, this is more of a cash flow kind of a management transactions and management uh, arrangements. So what has been done is that the amendments have been made to Ind AS 7 and Ind AS 107. Per se, they don't specifically state whether these arrangements lead to a classification as a borrowing, or whether these arrangements can be classified as straight payable. They don't highlight or they don't prescribe those consideration, but these are more of a disclosures which we might need to look at when we prepare financial statements with supplier finance arrangements. Yeah. So, as far as SEBI is concerned, SEBI had been quite active, especially in the context of related party transactions and its approvals, and we'll quickly look at what those amendments and changes are. Now, as far as the approval of related party transactions are concerned, it starts first with the audit committee, and there are certain list of information, minimum list of information, which are given by the management to the audit committee for their approval. Now, what SEBI has done is that SEBI has tried to rationalize this data points that has been shared to the audit committee and shareholders for their approval. Now, what SEBI has said is that for small value related party transactions, which are basically transactions less than INR 1 crore, right? For those type of RPTs, the SEBI will not prescribe any particular set of data points. So they are completely exempting these kind of small value related party transactions from the data points that SEBI would otherwise have prescribed. Now, in that scenario, what they have also stated that the board would need to form its own policy and decide what are those data points that should be shared by the management for approval of small value related party transactions, right? So again, we can say it's a ease of doing business, and or the other idea could be to focus their energies on a high value or maybe more complex kind of a transactions. Now, second practical expedient which SEBI gave is for transactions which are more than a crore, but which are still not very large related party transactions. So at present, we have a particular list of information which we anyway give. That list of information was prescribed by SEBI on 8th of April 2022. So for these type of transactions, which are basically not exceeding 1% of annual consolidated turnover or INR 10 crore, whichever is lower. In those scenarios, SEBI has stated that you continue to follow what you even follow even today. So for those particular transactions, we don't need to bother, and we can safely continue with the existing data points which management would have given to the audit committee and shareholders for approval of related party transactions. Now, what happens if my RPTs are neither small value nor they are within the 1% or 10 crore threshold? In that scenario, we have a SEBI related party industry standard. These were developed by SEBI in consultation with the Industry Standards Forum. This forum has representatives from FICCI, CII, and other industry voices, and it had very clearly tried to balance practicality and objective decision making. Before we get into the detail of this standard, they don't alter existing requirements. So that's the first point which I want to leave with all of you, is that these industry standards, they don't alter existing requirements. So for example, if there are particular transactions which are exempt under the SEBI listing regulations, for example, a transaction between the listed parent and its wholly owned subsidiaries, they continue to be exempted. So these data points or the related party industry standards is providing a list of information particular transaction wise for the consideration of management, which would be provided to the audit committee for their consideration. This particular standard is effective from 1st of September 2025, and SEBI and NSE has also clarified that these standards would apply prospectively, which means that any transaction which would be approved by the audit committee effective 1st September 2025 would need to comply with these particular data points. So quickly, if we have to take you through, if it is not a small value rated party or those RPTs where these simplified disclosures don't apply, then the entity should follow the rated party industry standard. Now, what this standard has also done is that they have tried to focus their attention on 7 specific related party transactions. For example, sale, purchase of goods or services, trade advances, intercorporate loans, investments, guarantees, sale, disposal of shares of subsidiaries, borrowings, or royalty. So they have focused their energies on the 7 particular related party transactions. Now, if I have to take a pause here and I want to bring another point to your attention, is that the level of disclosures which the standard is expecting varies based on a particular level. So let's start with the first step, which is part A. The moment you are in the ambit of SEBI industry standard, there are certain basic information which the management would need to provide. So whether you are a complex or it's those 7 specific RPTs, it doesn't matter. The part A disclosures apply uniformly for all related party transactions. Now, if there are focused or these 7 RPTs, then you have an additional layer of information that needs to be provided. Now let's move on to part C, which is basically out of these 7 transactions, if we are going to enter into a material related party transactions, but the sale of goods and services transactions are excluded from that list. If it is not that, then there is an additional layer of information which the management would need to provide. So if you would see on the slide, the level of information which the management would need to provide varies depending on the prescribed list as well as the materiality of these transactions. So again, if I have to repeat, a particular set or a basic information needs to be provided for all related party transactions, whether it covered under this 7 RPTs or not. If the proposed transaction is falling within the 7 prescribed transactions, then there are additional list of information which the management would need to provide. If these transactions are material, and then again there is an additional layer of information. So the level of information varies based on materiality and the focused list which SEBI has prescribed. Now, this particular standard also prescribes a particular list of information which would need to be provided to the shareholders. So again, a very important consideration, since we are already 1 month after the notification of this standard. For the upcoming audit committees or discussions, this might be an important factor for the management and those charged with governance. Few clarifications, considering this is the first time the standard would be implemented. The National Stock Exchange has issued certain clarifications, and we would like to highlight a couple of those clarifications. Now, one of the important expectation from the management is to certify that these transactions are in the interest of the listed entity. This certification was is expected to be provided by a particular set of KMP. For example, the CEO, company secretary, CFO, full-time director, manager. There was a concern whether this certificate by the selected KMPs has to be provided transaction wise. So the NSE has clarified that one single certificate is sufficient, and it can provide one certificate covering all the proposed related party transaction. Next clarification is, what if a particular KMP, for example, the CFO, is having a dual role? He is also the CFO as well as the whole-time director. So the NSE has clarified that the expectation of the regulator is that this certificate has to be signed at least by 2 different individuals. So one person might occupy 2 particular functions, but as far as the certification and the expectation of the regulator is concerned, in that scenario, there would be a separate or a different KMP who, in addition to the CFO cum whole-time director, would need to provide that certificate. Where the KMPs of the listed parent is obtaining certain information from the subsidiaries, then the certificate can include certain caveats that these are based on, for example, the information provided by the KMPs or responsible individual of those components, or they have been provided with a back-to-back kind of a certificate. So again, few of the important clarification which we thought might be relevant for you. Now, as far as the approval of RPTs by shareholders are concerned, that has also undergone a change. There had been a SEBI board meeting on 12th of September 2025, and what they are effectively doing is that they're trying to substitute the existing static threshold with a scale based threshold. So if you would look on the left, the at present material RPTs go to the shareholders for approval. Now, as far as those levels are concerned, the existing threshold is static. It says that either it is 1,000 crore or 10% of annual consolidated turnover of the listed entity, whichever is lower. Now, SEBI, in their discussion and outreach sessions with various stakeholders, observed that a significant amount of RPTs are going to the shareholders for their approval. So again, to ease of doing business, what SEBI has done is that they have made the static threshold agile with with the annual consolidated turnover of the listed entity. So if the listed entity has annual consolidated turnover of up to 20,000 crores, the threshold would now be 10% of annual consolidated turnover. If the turnover is 20,000 crores, more than 20,000 crores, or up to 40,000 crores, then the threshold changes to 2,000 crores to 5% of consolidated turnover more than 20,000 crores. So again, if you would see in a nutshell, the thresholds uh, have been uh, expanded, which means that lesser number of related party transaction would now go to the shareholders for their approval. Uh, in FRA roundup, I think we had spoken about these kind of interaction series in our previous sessions and previous interactions with you. But in this particular quarter, NFRA had released its interaction series on non-financial assets, and we expect more closer discussions between the auditors and those charged with governance or the audit committee members. So again, it doesn't change the accounting requirements, neither it changes the auditor's expectation or the auditor's rigor on these particular assessment. But again, this is kind of a data set or a particular questions which the audit committee members might ask uh, the uh, the auditors when they are discussing impairment topic. So questions which the independent directors or the audit committee members might ask is about the testing of internal controls. What are the procedures which the auditors would have carried on? That might be a question they ask. Whether the impairment has been identified as a significant risk or not by the auditors could be an important consideration for the independent directors or audit committee members. Whether the identification of cash generating units or impairment indicators that has been performed appropriately or not. Now, as far as the impairment indicators are concerned, did the auditor identify on its own certain impairment indicators which the management did not identify, right? And if the auditors have done so, whether they have been discussed with the management. As far as cash flow estimation is concerned, uh, whether the auditors have challenged the cash flow estimation, if the if there is a loss of market capitalization, right? Um, Whether the cash flow estimation reflects the time value of money, does it factors illiquidity as from the perspective of the market participant, whether the assumptions for cash flow projections are reasonable and supportable. Some of the other key considerations which the audit committee members might be concerned or interested is about the compliance of disclosure requirements of assumptions and judgments with the Companies Act requirements, with SEBI LODR, or with the Ind AS requirements. Another important consideration could be the allocation of impairment loss, the basis for allocation of impairment loss, and whether the order of allocation of impairment loss is consistent with the applicable requirements. Whether the auditor has considered impairment as a key audit matter and whether that has been being reported by the auditor or not. So again, these, as I said, these don't change existing requirements, but again, since these are issued recently in this quarter, we might expect certain discussions and certain interactions with the auditors and the members of the audit committee. So, well, that's all we had to cover. Happy to hear from you, and we will wait for your feedback, if any. Thank you.